But the reason why we're looking at these and why it's so important is all of this is tied to mortgages, and we know how important housing is in this country. We look at mortgage rates, and U.S. mortgage debt reached a record high in the second quarter, exceeding its 2008 peak as the financial crisis unfolded, according to the Federal Reserve Bank of New York. Mortgages are the largest component of household debt. That is why this is so important. And Brian, this is really why we kind of tie this all back to kind of recession risks, because we talk about housing, and it does bring back a lot of those memories that a lot of people had in the Great Recession. What are your thoughts on that connection there?
So mortgage debt reaching these levels is obviously of concern, but when you consider the fact that it doesn't control for the population increase, I mean, you can make the argument that maybe this is actually not all that unusual and that it's just kind of trending with the population increase that we've seen in the United States. Now, what is kind of important to delineate here is that obviously on an individual basis, handling your mortgage debt and being financially smart about planning that type of thing is really important. But most economists on the macro scale have not flagged the household or the consumer as the glaring issue in the economy.
So far, they've held up.
Right, they've said the consumer.
I
mean,
confidence.
Yeah, I mean.
It's stuck.
Exactly. And, you know, people are still going out and making these purchases. People are still buying homes at a rate that's been healthier than we saw in the lead up to the financial crisis.
And isn't credit quality also better? I mean, I remember, you know, going into the crisis, I was recently out of college and I had friends who were buying condos at 23 years old. It made absolutely no sense. And, you know, the ninja loans. And now, you know, I think credit quality is a little bit better. Banks are a little bit more cautious about the lending.
And that's a great point you bring up. I mean, banks have become more smarter about the way that they underwrite loans. A lot of banks no longer have subprime divisions, although you can debate to what degree they just no longer have a subprime division, but they just kind of still kind of have a little bit of loose underwriting standards. But on the whole, the banks have stronger capital requirements now. The Fed has been supervising them closely. You know, they have higher requirements than they did before the crisis. But I think the bigger question here is really on the corporate side, right? Corporate debt has been the issue that you know, economists have really pointed to. So it's not necessarily mortgages, it's some of these companies, some of them which are publicly traded, that have been saddled with so much debt that are being rated at, you know, triple Bs that might not be able to pay that out if there were to be some sort of issue or bankruptcy wave that could take some of these companies out. And who knows what the ripple effects might be through the financial system if they can't follow through on their debt obligations.
And that's always kind of the fear, too, when we talk about interest rates being low, is that it might fund some sort of bubble here, and we talk about asset bubbles. At least, if what you're saying is true, that these little checks that were supposed to be put in place to kind of prevent another housing bubble, at least those are holding up when we look at this. Who knows what other asset bubbles might be fueled by low interest rates, though. We'll leave that there for now. Brian Cheung, thank you so much for breaking that down.